Marcus had been checking his credit score every single week for 8 months straight. He was disciplined. He was careful. He did everything the app told him to do. The morning he walked into that dealership, his phone showed 724. He felt ready. He felt like someone who had done the work. The finance manager came back from the back office with a different number. It was 689. Same person, same history, same life, different number. Marcus asked how that was possible. The manager just said the system uses its own scoring. He handed Marcus a loan offer with a rate he had not prepared for. That moment has happened to millions of people, and almost none of them understand why. Not because the system is broken, because the system was designed this way from the beginning. Here's the thing nobody tells you when they hand you a free credit monitoring app. The score on that screen is not the score lenders use. It was never meant to be. FICO, the Fair Isaac Corporation, does not have one credit score. It has 28 different industry-specific scoring models actively in use across the United States lending market today. When a mortgage lender pulls your credit, they are looking at FICO Score 2, FICO Score 4, or FICO Score 5. Depending on which credit bureau they access, those models were built specifically to predict mortgage default risk. When an auto dealer runs your credit, they pull FICO Auto Score 8 or Auto Score 2, 4, or 5. Those models weight your history of installment loan payments differently than a generic model would. When a credit card issuer checks your application, they likely use FICO Bank Card Score 8 or 1 of its industry-specific variants. Each one optimized for a different type of financial behavior prediction. The Score Your Free app shows you as most commonly VantageScore 3.0 or a base FICO Score 8. Both are real scores. Both are calculated using real credit data, but neither one is what your lender is actually looking at. Think about what that means for a second. You have been training for the wrong exam. Marcus had spent 8 months watching one number, celebrating when it went up, making decisions based on its movement. But the mortgage officer looking at his file was reading from a completely different book. The gap between a consumer-facing educational score and an industry-specific FICO model can range from 20 points to over 50 points in either direction. That is not a rounding error. At 724, Marcus believed he was comfortably in prime borrower territory. At 689, he was sitting at the low edge of a different interest rate tier entirely. One tier up can mean tens of thousands of dollars over the life of an auto loan. And here is the reversal that most people never reach. The things that raise your consumer score are not always the same things that raise your industry-specific FICO score. FICO auto score models place significantly more weight on your history with auto loans specifically. If you have never had a car loan, your auto score may underperform your general score in ways your app cannot show you. FICO mortgage models, particularly the older Score 2, 4, and 5 versions, treat certain collections and public records differently than the newer FICO Score 8 or 9 models do. Medical debt, for example, is handled differently across model generations. This is why two people with identical base FICO Score 8 readings can walk into the same mortgage lender and receive meaningfully different rate offers. They have different histories with the specific behaviors each mortgage model weighs most heavily. So here is what I want to ask you directly. Have you ever been surprised by a lender's decision when you thought your credit looked strong? Tell me what happened in the comments below, because you are almost certainly not alone in this. Now let us go back to Marcus, because his story gets more complicated from here. After the dealership, Marcus went home and started researching. He found out he could purchase his actual FICO auto score directly from myfico.com. The price for a full set of scores across all bureaus and models was around $40. He bought them. He finally saw the number the dealer had seen, and then he saw something else. His Equifax auto score, his TransUnion auto score, and his Experian auto score were all different from each other. Not by 1 or 2 points, by 11 points across the range. 3 bureaus, 3 reports, 3 slightly different data sets, 3 different outputs from the same scoring model. Because the underlying credit reports themselves are not identical. Lenders are not required to report your account history to all 3 bureaus. Some report to 1, some report to 2. Some skip a bureau entirely. So your FICO Auto Score 8 calculated from your Equifax report may be built on slightly different raw data than your FICO Auto Score 8 from TransUnion. Same model, different input, different output. The lender picks which bureau to pull. You do not get to choose. You do not know in advance which one they will use. You are showing up to a test without knowing which version of the material will be on it. This is the structural contradiction at the center of the entire consumer credit monitoring industry. The industry that earns revenue by getting you to check your score regularly is showing you a score built to educate and engage you, not to replicate what lenders see. That is not a conspiracy, it is a business model. VantageScore was created jointly by Equifax, Experian, and TransUnion in 2006, partly to offer an alternative to FICO, and partly to give consumers a standardized free score to track. But tracking it became conflated with knowing your actual creditworthiness in lender terms. And here is the third reversal that reframes everything. FICO Score 8 itself, the base version your app might actually show if it uses FICO branding, is also not the score most mortgage lenders use. The mortgage industry has been largely locked into older FICO models, versions 2, 4, and 5, because those are the versions required or accepted by Fannie Mae and Freddie Mac for conforming loan underwriting. There has been a push to modernize and incorporate FICO Score 10T and VantageScore 4.0 into the mortgage market. That transition is underway but incomplete, meaning right now, the most consequential credit score most people will ever face, the one that determines whether they can afford a home, is calculated by a model built on logic from the 1990s. Marcus eventually refinanced. He spent 3 months before his refinance application doing something almost no consumer guide told him to do. He pulled his actual mortgage-specific FICO scores, identified which of his 3 credit reports the lender would likely use, and focused his credit actions on that specific report. He disputed a small error that appeared only on his Experian report. He paid down a card that reported to all 3 bureaus, and he waited for the update cycle to close before he applied. His mortgage FICO score on the day of application was 14 points higher than his consumer app had predicted. He qualified for a rate tier that saved him over $200 a month. The gap between what the system shows you and what the system uses is not accidental. It persists because it is commercially functional for the companies running the monitoring platforms. It persists because regulators have not required consumer disclosure tools to match lender-facing scoring systems. It persists because most people never think to ask which specific model a lender is using. You are entitled to ask that question. Before any major credit application, you can call the lender and ask which credit bureau they pull and which FICO model version they use. Most will tell you if you ask directly. Almost no one asks. The uncomfortable truth is this: the financial system built a tool that made you feel informed while keeping you functionally blind to what actually mattered. The score you were trained to watch was a mirror designed to engage you, not a window into the room where the real decisions were being made. Marcus learned that. You just did too. Now the question is whether you check the score you are comfortable with, or whether you go find the score that actually decides your financial future. Drop in the comments. Did you know there were 28 different FICO models? Or did this completely change how you think about your credit score?